I've been in the stock market since 2008, in real estate since 2011. Over the years, I've tested different asset classes, different markets, and different strategies. And here's what I learned. Most investors don't lose money because they choose bad assets. They lose money because they don't have structure. Random stocks, random crypto, maybe a rental, maybe some cash sitting in the bank. That's not a portfolio, that's chaos. Today, I want to show you a 30-30-30-10 structure, a model that works very efficiently when building a long-term capital. I'm Ravi Gabis, and welcome back to the Gabis Show, where we unlock the secrets of real wealth in the United States every single day. If you want to master investing the right way, subscribe now. I publish every single day. This is a practical business and finance university. And there is a free investing webinar in the description if you want to go deeper into capital allocation step by step. Watch it after this episode. We continue talking about investing. Today, I want to give you an example of an investment portfolio. This is not a template. There are many ways to build a portfolio, but this is how mine is structured. I call it 30-30-30-10. Here's how it works. 30% in the stock market, 30% in bonds and fixed income, 30% in real estate, and 10% in life insurance. And each part has two layers, a conservative layer and an aggressive layer. The first part, stock market, 30%. Inside the conservative layer, we have broad exposure. For example, S&P 500 index funds, low-cost Vanguard ETFs, broad market ETFs, dividend ETFs. These typically generate around 8 to 10% annually over the long term. In the aggressive layer, we move into individual stocks, IPOs, cryptocurrency, startups, your own business, Forex. Returns here can be much higher, but so is the risk. And here's something important. The stock market is business ownership. When you buy stocks, you are buying a piece of a company. Entrepreneurs often perform better in the stock market because they understand business fundamentals, revenue, margins, cash flow, management. Stocks are not just abstract numbers on a screen. You are an owner, and sometimes investing in your own operating company, if it's already profitable and tested, can be one of the highest return investments you make. Not starting from scratch. It's important. But scaling something that already works. The second part, bonds and fixed income, 30%. Again, two layers, conservative layer, US Treasuries, government bonds, investment grade corporate bonds, bond ETFs, bank deposits. These provide stability and predictable income. Returns are lower, but risk is lower as well. In the aggressive layer, you may include high-yield bonds, emerging market bonds, corporate bonds in high-rate economies, private credit, peer-to-peer lending. For example, in the United States, private lending can generate 10 to 15% annually, depending on structure and risk. In high inflation markets, returns can be significantly higher, but currency risk might always be considered. Higher yield always means higher risk. Never forget about that. The third part, real estate, 30%. Conservative layer, long-term rentals, multifamilies, in stable markets, REIT ETFs. It allows you to own real estate through the stock market, even with small amounts of capital. In the aggressive layer, BRRR strategy, short-term rentals like Airbnb, fix and flips, development projects. Now here is something important. Real estate becomes risky when leverage becomes excessive. If you use your own capital carefully, you are investing. When you aggressively combine debt and speculation, you are operating a business. And business carries higher risk. It's not only about investing anymore. Know which role you are playing, investor or entrepreneur. The fourth part is life insurance, 10%. This part surprises many people. In the conservative layer, whole life policies with guaranteed cash value, indexed universal life linked to the S&P 500 This offered downside protection with capped upside. In the aggressive layer, leverage policy loans, variable universal life policies, these are market linked and carry investment risks. Yes, it's insurance, but you still experience market volatility. Life insurance in a portfolio is not about return maximization. It's about structure, protection, tax efficiency, and long-term capital strategy. This is an example of a structured portfolio 30, 30, 30, 10, with conservative and aggressive layers inside each category. You diversify not only by asset class, but by risk profile inside each class. That's how you build durable wealth. If you want to master investing the right way, subscribe now. I publish every single day. This is a practical business and finance university. And there is a free investing webinar in the description. If you want to go even deeper into capital allocation step by step, watch it after this episode. I'm Ravi Gabis, and I'll see you tomorrow.